today's webinar is to provide an overview of what the role that foreign currency plays in investment portfolios and where foreign currency hedging fits into that equation, so that InvestNow customers can make an informed choice as to whether or how much one should hedge their foreign currency exposure. So for some housekeeping, please note that this webinar is purely for educational purposes only, as InvestNow does not provide any personalized financial advice. We are, however, strong advocates for it and actively promote the benefits of seeking personalized advice from qualified advisors external to InvestNow. So with that out of the way, let's dive into the presentation. So we have quite a few things to run through today. So I'll provide an overview of what investing in overseas assets entails and how foreign currency movements impact your investments. And then we'll kind of segue nicely into what is currency hedging and the kind of pros and cons of hedged versus unhedged funds. We'll do a little bit of an insight into how professional managers approach the hedging equation, as well as provide an overview of how performance is stacked up. Ultimately, though, I do want to bring it back to the investor, so you guys. So we want to then highlight, how you can apply a hedging strategy that does meet your investment needs, and a little case study into how we can customize the hedging ratio using some of the new Foundation Series funds, for example. At the very end, we'll have a Q&A session as well. So if you do have any questions, please do fire them through in the comment box, and I'll do my best to get through as many of those questions as possible. So without further ado, let's kick in then. So overseas investments like shares and bonds make up an increasingly large portion of New Zealanders' investment portfolios. As Kiwi investors, our investments are generally valued in New Zealand dollar terms, as that's the local currency that we get paid and spend. The value of our overseas investments in New Zealand dollar terms, however, is impacted by two key factors. One is the asset return on the investment that you've actually made, and two, it's the foreign currency return based on the foreign currency that you had to undertake your exchange in order to get investment exposure to that specific asset. So to better understand this, let's understand schematically what really happens when you, as a New Zealand investor, invest money into overseas assets. So let's say you, as this New Zealand investor, wanted to put $100 New Zealand into the US share market. Well, the US share market, is not denominated in New Zealand dollars, it's in US dollars. So you'll need to change your $100 New Zealand into US dollars. Let's say you did that at the exchange rate of 1 New Zealand dollar is equal to 50 US cents, or conversely, thinking about it in the other way, 1 US dollar is equal to 2 New Zealand dollars. That means your $100 New Zealand gets converted into $50 USD, and that's how much gets invested to the US market. Let's say, for example, it's the S&P 500. Well, when you want to then get your money out, what you'll need to do is work through the other way. So you still just have $50 USD of assets, but you want to convert this back into New Zealand now. Let's say the exchange rate has changed. So the New Zealand dollar in this example has weakened. Rather than getting 50 cents USD before, you now only get 40 cents. What this change in exchange rate means is that when the New Zealand dollar has weakened, the US dollar has conversely also strengthened. So your 1 USD before, which was getting you 2 New Zealand dollars, is now getting you 2.5 New Zealand dollars. So therefore, because you had $50 USD of assets, when you convert that back into New Zealand, you get $125 New Zealand. So this is a return purely just from the foreign exchange of 25%, and we've assumed zero return in your S&P 500 investment. So this it's quite extreme, but it just highlights how foreign currency exchange can really make a drastic impact on your portfolio returns, because we've really just isolated foreign exchange here. To kind of summarize the impact then, what happens is that when the New Zealand dollar strengthens, then conversely, the US dollar would weaken, and that will lead to a return on your foreign currency that is negative. The reason why it's negative is because we've invested into the USD assets, being the US currency in this case, and then because the USD has gone down, that means our investment, our asset, i.e. the USD, has actually gone down. Therefore, it returns as a lower return on our portfolio. Conversely, when the New Zealand dollar weakens, that means the US dollar strengthens, and then therefore our foreign currency return is a positive, and that adds to our returns. So it's a bit confusing sometimes to try and get your head around, which way goes where, because there's kind of two currencies involved here. So we'll try and, for the most part, stick to a consistent way of explaining things. But really, they are kind of two sides of the same coin. Pardon the pun there. So kind of going into a bit further into, this, how does foreign currency really impact your investments? Well, again, as we kind of noted, there's two components there. One is your overseas asset return, and two is the foreign currency return, which together get you your overall total return in New Zealand dollar terms. So before, in the previous example, we basically assumed a 0% asset return, which isn't a great assumption because the reason why we want to invest into overseas markets is to actually generate a positive return. So this time, in the example, let's assume that our S&P 500 investment has actually returned us 10% across the board. Okay, cool. So let's go through three different scenarios then. So we've got 10% return from our S&P 500. What this means, if the USD were to decrease in scenario one by 2%, that means our overall return in New Zealand dollar terms actually goes to 8%, because we have the 10% from the S&P, we have a 2% drag on our return due to the foreign currency, and that means our overall return is around 8%. Conversely, other way around, if the USD relative to the New Zealand dollar increases by 2%, so our original 10% S&P return gets boosted by 2%, giving us an overall return in New Zealand dollar terms of 12%. And then if there is no foreign currency exchange return in scenario three, then our return in New Zealand dollar terms just matches the return in the offshore, so the S&P. So we've kind of put, rough figures here, approximate, just because the way that percentages work, it's not a quite one-for-one thing where you add things, just because if you're getting an additional 2% return on your 10%, you're actually getting, your $100 becomes 110, you're getting at least 2% on that. So you end up getting 2.2, so your return is really 12.2 instead of 12, but, for rough figures and to keep the math simple, we've basically just kept it as whole figures here. But really illustrates, how foreign currency can really add and also track to returns. So that kind of, we kind of look at it from those perspectives, 2%, it's not neither here nor there. So how much can foreign currency really impact your portfolio? So if we kind of look at this graph here of the New Zealand dollar and US dollar chart over the last 10 years or so, we can kind of see that there's been two quite significant periods over the last 10 years where the currency has moved quite significantly. So the most recent one was over the COVID period. So in that period, around end of March to around the following February, we did see the New Zealand dollar strengthen by nearly 20%. So conversely, that means that the USD would have weakened by roughly 20% as well. So as we kind of discussed before, the way that we need to think about the in return on the New Zealand investor or New Zealand dollar terms is that if there's a 20% decrease in the USD, that means there's a 20% drag on our returns. So even if our S&P 500 index return, let's say, was 25% over that period, the fact that the NZD USD exchange rate decreased by 20% means that our return was only 5%. So it can be quite significant in that regard. Equally though, in the period kind of mid 2014 to around 2015, we did see the NZD weaken by 27%. So that conversely means that the USD strengthened by around the same amount. So, if our return during that period on the asset was let's say 5% again, then the actual return in New Zealand dollar terms would have been boosted by around another 27%. So they would have given us a 30+% return. So you can see how significant the returns can be. And I think the ultimate kind of key point there, and if you were to take nothing else away from this webinar other than just this one piece, would be that currency movements are an additional driver of risks and returns above and beyond just the offshore asset. So another way to think about it is when you're investing into offshore assets and you don't hedge any of your exposure, you're essentially almost investing into two separate assets altogether. One being the underlying investment, say the S&P 500, and the other being, you're investing into a foreign currency. So both can have a significant impact on your in returns from a New Zealand dollar perspective. Cool. Moving on a bit then, that kind of segues nicely into, what is currency hedging then? So currency hedging is a strategy designed to mitigate the impact of currency fluctuations on the value of your offshore investments in New Zealand dollar terms. So what that means there is essentially when you want to hedge something, you're trying to neutralize all the currency exposure, so that you're just basically left with the exposure to the underlying market that you're trying to invest in. So the hedge ratio will determine the extent of a fund's exposure to currency movements. So a fully hedged fund would have a hedge ratio of 100%, and that will target a return in New Zealand dollar terms that is in line with the underlying investment. So in the example we used before, a 10% return in the S&P 500 would be in hedge returns 10% in New Zealand dollar terms as well. An unhedged fund, on the other hand, has a hedge ratio of 0%. And what happens there is that you are both exposed to the underlying investment as well as any movements in the currency as well. So you kind of going back to our example before, if the S&P returned 10%, but then the foreign currency returned -2, then your overall unhedged return in New Zealand dollar terms would be 8%. So that's kind of, what hedging is in a nutshell. If we kind of move forward to the key characteristics of hedged versus unhedged funds, probably the key thing that would stick out right away is that many hedge funds would have the actual word hedged in its fund name. So, for example, we're looking at the Russell Investment Sustainable Hedged Global Shares Fund would be a 100% hedged version of the unhedged fund, which is the Russell Investment Sustainable Global Shares Fund. So there's quite a few of these kind of hedged and unhedged counterparts that we have on InvestNow, and it usually reflects the fact that, one of the funds would be fully hedged and one is not hedged at all. So then as the end investor, you can kind of mix and match between the two to cater your hedge ratio accordingly. Notwithstanding that though, there are some funds that don't have hedge in the name, but still incorporate some type of hedging approach. So if you wanted to find out the specific hedging approach within the fund itself, you will need to check out the fund's statement of investment policy and objectives, or the SIPO document, which would outline specifically how much the hedging. So for example, the Mercer All Country Global Shares Index Fund, which is a popular global shares fund within InvestNow, doesn't have the word hedge in its name, but it does incorporate a 69% hedge ratio in it. And that's kind of the detail you'd only really get if you were to look into the underlying documents. So in this case, the SIPO. The other kind of key feature that you would notice when comparing these hedged and unhedged counterparts side by side is that hedge funds tend to have higher fees. So the higher fees reflect the fact that for the underlying manager, it does cost extra in order to basically buy the currency hedging exposure to insulate yourselves. So kind of how hedging works schematically is that the underlying fund manager would engage with usually a bank, such as like the BNZ or the Citibank or whoever they usually partner up with, and to essentially agree on a contract that would say that, I've bought these assets for, let's say, 50 cents USD. Irrespective of what happens to the US dollar, I want to have a guarantee that when I will sell these assets, I will still get 50 cents USD. So that's essentially how they were able to neutralize that exposure. But the fact that they enter into this contract means that the bank would still need to make some money for offering that service. So usually that extra cost of hedging would be either reflected within the management fee. So in this case, you can see, for example, the Vanguard fund has a 6 basis point higher management fee. The Russell fund is a 2% higher, 2 basis points, higher management fee, et cetera. And that just reflects the fact it's almost like an insurance premium. So you're paying for the privilege of being able to mitigate your risk and just isolate the exposure to just the pure market. So moving forward a little bit now, I guess probably the key crux of what our discussion would be on today is the age-old question of to hedge or not to hedge. So, we countless questions of this from InvestNow customers all the time. So, should I go into the hedge fund? Should I go unhedged? So I guess the bottom line is there are strong arguments for both sides. And, like many things in the investing world, there is no right or wrong answer. So if you kind of join this session today to try and get a definitive answer from me, unfortunately, that's not what we're here to do. But what we can do is probably go through some of the pros and cons and some of the reasons why you may want to go hedge versus unhedged, and then tie this back to your specific situation to see what fits well. So kind of going through the options on the hedge side, or why you may want to go for a hedge fund versus an unhedged fund. Probably the number one reason would be the fact that the hedge fund provides that pure market exposure. So for many Kiwis, when they're investing into international assets, they would generally be trying to target just the pure market movement. Like, for example, our customer service team will probably be able to tell you countless times how many times someone's called up and be like, I invest into the US 500 fund, and I saw that the S&P 500 went up 10% over the period, but then the US 500 fund only went up, 7%. Why? What happened? What's the difference? So that difference is, usually down to the foreign currency exchange. So not only are you getting exposure to the underlying investment there, in that case the S&P 500, you're also getting exposed to any movements in the NZD or USD. So if you wanted to invest into the S&P 500 and nothing else, and that was your investment goal, then going through a hedge option makes a lot of sense in that front. If, however, you also wanted to be exposed to currency movements, then going unhedged makes sense too. Kind of the second reason why you may want to go down a hedge route is probably because hedging aligns better with certain assets and the investment objectives of those assets. So for example, asset classes like bonds and property tend to be more on the defensive side, in the sense that a lot of investors would invest into them because they want basically a fixed stream of income, and they want that to be very much like in the low volatility side. The reason why you'd want to hedge stuff like global bonds and global property is because if you say invest into a bond that paid you 5% interest, but then the currency movement, was say -10%, that you end up actually losing money off of that, that kind of defeats the purpose of investing in the bonds in the first place, because you wanted an almost guaranteed return. So that's why for most New Zealand fund managers, they would basically almost 100% always hedge global bonds. And equally with global property, you'll probably get somewhere around the 90% hedge ratio, which is what the BNZ kind of survey has showed us recently when they go through the survey of all the fund managers and how they approach hedging. Probably the last reason you may want to consider a hedge fund is because as Kiwi investors, we tend to ultimately spend our investment returns in the New Zealand dollar. So whether it's spending for retirement, spending for groceries, spending for our child education, a lot of it would always be done in the New Zealand dollar terms. So from an investment perspective, having a currency hedge fund would keep the return stable in NZD terms. So you kind of rest assured that, at the end of the day, when you come down to retirement, whatever it is, that you will basically be able to get the end, like kind of asset goal that you wanted, and that will be stable from a New Zealand dollar perspective. Kind of conversely, and then kind of the flip side to that argument, however, as well, and in favor of the unhedged side, would be that from an unhedged perspective, if you were to invest into unhedged funds, you would be exposed to foreign currency, and then that kind of provides you a bit of diversification in that front. So not only would you be having assets in New Zealand dollar terms, but you also have assets in foreign currency terms, which can act as a good kind of buffer to your portfolio as well, because kind of worst case scenario, touch wood here, if anything happens to New Zealand economy, then that could lead to a significant portion of New Zealanders' wealth, which is tied up in New Zealand assets, plummeting. Whereas if you diversify it across different foreign assets, whether it's USD, Australian dollar, Japanese yen, whatever it is, then at least you're insulated from just the happenings of what happens in New Zealand. Because if you think about it from a global perspective, New Zealand is quite a small kind of dot in the grand scheme of things, especially relative to the global economy. So it does make a lot of sense from that perspective to kind of diversify. Like any other thing, just if you think about foreign currency is just another asset class, it makes sense to diversify your assets across a few different baskets. Equally, with that, a lot of our New Zealand spending, we feel like it's all done in New Zealand dollar terms because that's what we get charged. But stuff like oil isn't actually determined by New Zealand dollar prices. It's determined mostly by the US dollar, for example, right? So in that sense, it makes sense to actually hold some USD assets, because then you aren't insulated too much from oil prices going up and down, because then you would have it more or less fluctuated just based on the underlying oil markets rather than just the US in New Zealand dollar having you're basically going through a bit of a turbulent session. So again, currency, if you think about another asset, would just provide additional diversification. So a factor in favor of the unhedged side. Another factor in favor of unhedged would be the fact that we've kind of touched on earlier, hedging is more expensive. So we can kind of think of it as an insurance premium. So because fund managers are charged additional to offer this hedging service, that means that these costs are passed on to the end investor. So if you were to take on these costs, you would basically be paying an insurance premium because you are insulated from any adverse movements. But the thing is, you could also, not have needed that insurance in the first place, in the sense that currency movements could have favored you, but you wouldn't have gotten that benefit because you were fully hedged anyway. So it can be a bit of a double-edged sword, but for a lot of people, that do want the fewer volatility in the actual underlying return of the asset, they could favor a hedged approach. Whereas someone that is a bit ambivalent about whether currencies are here or there, then it makes more sense to probably go unhedged, because then you saved on the additional cost that the hedge funds would have charged you. And finally, and kind of counterintuitively, going unhedged can actually reduce some of the volatility in your fund. The reason being is that a lot of overseas assets are denominated in US dollar terms, which is kind of like the global safe haven currency. So when stuff like kind of, like a war breaks out or there's some very volatile happenings in the market, then usually what happens is people will start fleeing to the US dollar. So for example, if the market started tanking, let's say it lost 10% in a day, then usually the reason that would have happened was because something would have happened in the world. Let's say a war broke out, then people will start flocking to the US dollar. So from a New Zealand dollar perspective, although we did lose out on the underlying market going down, because the USD also started increasing, as New Zealand investors, we also would have benefited a little bit from that foreign currency going up. So then therefore our in return wouldn't have been as bad as if we didn't have any exposure to the US dollar at all. So from that perspective, the volatility could decrease as well. I can go into that a little more detail in the Q&A section as well, because that can be quite complicated. So a bit of color as well in terms of helping you make that decision of whether they're hedged or unhedged. It's always good to take a note out of the book of professional investment managers and see how they approach it. So the BNZ survey went through basically all the investment managers in New Zealand and kind of queried how they've been approaching things. So you can basically see from a global shares perspective, they've more or less been hedging around that 50% region. And it's just reflective of the fact that you can see good arguments on both sides of the hedging debate. So to kind of get the best of both worlds or the least regrets approach, you can kind of go right down in the middle in terms of the hedging for global shares. So you can benefit if things go well, but also you're insulated if things kind of go upside down. And kind of as I've noted before with global bonds and global property, they're basically almost fully hedged for those funds because of that defensive nature. So in terms of hedged versus unhedged performance, which is another good question we always get, this graph here shows you the return that the hedge fund would have made in any 1 year within the MSCI All Country World Index, which is basically a global stock market index, has roughly around 9,000 different stocks in there. So you can see from year to year how much the hedged version of the fund performed the unhedged version. So across that period from around 2009 to 2015, hedge definitely came out on top. Whereas from around 2015 onwards to probably around the last couple of years, it's been neither here nor there. So you can go either be hedged in favor 1 year, unhedged the other year. Past couple of years has been in favor of unhedged, but again, currencies are very difficult to predict. So if you're trying to just base your hedging approach to try and capture the short-term uplift you would receive from going either hedged or unhedged, we would probably be strongly cautioned against doing that. It's almost akin to trying to chase individual stock performance. So people can do it, and you can get some good returns out of it, but at the same time you can get burned significantly. So just be very careful around that. We would much rather, kind of investors go through an approach where you are picking a hedging strategy that aligns with your investment goals and constraints, which is a tried and true way to, long-term success in investing, rather than just trying to, pick a hedging approach to chase those short-term currency gains. Because, the BNZ report also had a question about who investment managers think has the best ability to predict currency movements, and the overwhelming majority is, or 61% of respondents said nobody can predict what's happening in currency markets over the next 12 months. So again, be very cautious on that. But yeah, to bring this all back to you as an investor, so what are the kind of things you may want to consider when deciding on whether to go hedge or unhedge? So probably number one would be just what are you trying to achieve with your investment exposure? So again, as we kind of just touched on earlier, if you're someone that wanted just that pure market exposure, then it makes a lot of sense just to go for a hedged option, because then you're just getting whatever the underlying market goes. So if the S&P goes up 20%, you're going to go up 20%. If you got an unhedged option, then it'll be 20% and then plus or minus whatever's happened in the currency markets. So again, what are you trying to achieve would probably be the number one thing. The second one would probably be just your volatility or your risk tolerance. So as we kind of discussed earlier, if you think about foreign currency as just another asset class, you're essentially introducing another driver of risk and returns to your portfolio. So just how comfortable are you with that? Currencies can go up significantly. They can also just basically go sideways. But again, no one really knows what's happening in the currency market. And you would really be making an active choice to include that if you were to go unhedged. Whereas if you go hedge, you're basically just isolating yourself to the underlying investments volatility itself. So again, think about how comfortable you are with volatility. The third thing will probably be around just diversification and how diverse your investment portfolio is already. As we kind of touched on earlier, if you think about foreign currencies as an asset class, it can make a lot of sense to have different options in there in your little basket to, if anything happens to the New Zealand dollar, for example, then you aren't fully exposed to just, one small nation out of, the global markets, basically going, bonkers if anything goes wrong. So diversifying across different asset classes makes a lot of sense as well. And it kind of ties in nicely with the fact that a lot of our ultimate spending isn't determined by what happens in New Zealand dollar, but by foreign currency. So, even stuff like meat and dairy isn't determined purely by the NZD. A lot of it is determined by what's happened to the US and China markets, or oil would be a lot, happening in the global markets. So diversifying, having exposure to different foreign currencies can help insulate your portfolio. And finally, just the cost considerations. So this, again, as we kind of touched on, hedging does cost additional for the end investor, whether it's at a higher management fee. So, there's no such thing as a free lunch. So if you are ambivalent on where the currency goes here nor there, or you're kind of of the view that currency will probably be even out over the long term, then maybe it doesn't make a whole lot of sense to pay that extra premium to have that exposure hedged. But if, kind of mitigating the impact of currency is very near and dear to you, then paying that little extra may be well worth it. So bringing this all together and kind of tying this back into a case study. So we can customize our hedging ratio using some of the new Foundation Series funds that we've just launched. So as some background on this, so we originally launched the Foundation Series US 500 and Total World funds about a year ago, which gives you some of the cheapest exposure you can get to, Vanguard ETFs. So the ones in particular that you get exposure to are the Vanguard US S&P 500 ETF, or VU, and the Vanguard Total World Stock ETF, or VT, and these come at super low management fees of just 3 and 7 basis points in line with the underlying ETF. You do get hit with a transaction fee of 50 basis points on every entry and exits, but that is a one-off fee. So if you are kind of a long-term investor, anything kind of 5+ years, then this would still be one of the most efficient, cost-efficient ways you can get exposure to these Vanguard ETFs and to global shares more broadly. So initially, when we launched these, we just had the unhedged versions, but we recently launched the hedged versions of the attached, which basically allows our investors to cater their hedging approach to whatever best aligns with their specific needs. So you could go fully unhedged, in which case you'll just invest into the Foundation Series US 500, for example. You go fully hedged, in which case you'll just invest into the hedged US 500 fund, or you could have a custom hedging level. So in this case, I've selected 50% hedge because I like to get the best of both worlds. I see the benefits of both sides, and then basically I'll just split up my investment between the unhedged version of the fund and the hedged version of the fund 50-50. And that basically guarantees that if anything happens in the markets, I get a little bit on the upside, but also I'm insulated from anything drastic happening on the downside. So all this is showing you is that you now have options to cater your approach based on your investment constraints. And you can basically, go from 0 to 100 or anything in between using a combination of these two funds. So that probably brings us to the end of our formal presentation here. So now have a session for Q&A. So if you did have any questions that you wanted me to address, please just fire them through in the box on the right, and I'll try to get through as many of them as possible. So let's try to work my way down. Let's see. So got one question here. So what are the cons of hedge for the US 500 if the fees are the same? Yeah, so the management fees are the same. So I guess as we kind of discussed in terms of the pros and cons before, there is a cost to hedging as well. So although the management fees are the same, the bank that we partner up with in order to offer this hedging service does need to make some money for offering the service to investors. So the way that they make money is they basically make it in the spread. So essentially, when we are going through and buying the specific currencies, there's the market price that would be available, and then the bank would basically take a slightly lower price than that in order to have a better, basically make the money from their end. So the way that is reflected in the fund is that it would just be a slight drag on the performance. So, rather than maybe going up 10%, if it was fully hedged, it may go 9.995 or something like that. So the cost usually is very small. It's just a couple, like a basis point here and there. And again, if you are fully hedged, then the potential downside would be if the currency moves favorably in your direction, as in if you were i.e., if you were unhedged, you would have made maybe an extra 10% from the currency. You wouldn't make that in a hedged version because you've basically insulated yourself fully from any gains or losses. So it's just a diversification tactic, but something to be aware of there. Cool. Next question. Can I share the replay with friends who missed the webinar? Yep. So we'll be sending through a copy of this webinar right after this. So you'll feel free to share this with whoever you want and watch it at your own leisure. Next question. I think I saw the foundation series funds have the same fee for both hedge and unhedged. How is the fund able to offer the hedging at the same fee? Yeah, so I kind of addressed that before. So the management fees are the same, the transaction fees are the same, and the way that the underlying kind of hedging provider makes their money. So the bank, in this case that we work with, is that they'll basically just kind of get a favorable rate. So it's kind of in the same way that if you go to a foreign currency exchange, you're about to go on holiday, you go to the exchange little retail store, and then they basically say they don't do any commissions, but they are offering you the rates at certain, the NZD AUD rate at a certain number that says 905. So the way that those companies make money is that they can get the rate slightly better, and then they charge you a certain rate. So that's the difference essentially. So you would see that as a drag on your returns very, very slightly, but nonetheless, it is not free to offer the hedging service. Cool. Let me know if that makes sense. Otherwise, happy to kind of explain it further. And again, I'll put my email towards the end of this webinar as well. So if you have any further questions, feel free to just pass them through to me. But I'll try to get through as many as I can now. Let's see. Will you share the slides? Can you request them? Yep. Oh, happy to share the slides. And again, the recording will be there as well. Next question here. Are there any foreign tax implications for unhedged? Is there any difference in how tax works between the two? Yeah, so that's a great question, actually. So short answer is there's no additional kind of foreign tax implications of going hedged versus unhedged, in the sense that all the funds that we offer on InvestNow are basically PI funds. There is a couple being the Vanguard funds that are Australian unit trusts, so they are taxed quite differently. But again, it's all within the hedged and unhedged counterparts, it's all consistent. So with PI funds, for example, you are only taxed at the maximum rate of 28%, which is based on a deemed dividend that you earn of 5% per year. So essentially, you have a maximum tax bill of 1.4% of your assets every year, 1.4% being your 5% deemed dividend return times the 28% tax rate. So that 1.4% is a final tax that goes through the fund itself, and they basically just deduct that for you, so that you don't have to do any additional tax treatment. And so that would be the same treatment across both the hedged version of the fund and the unhedged version of the fund, because they're purely PIs. Now, if you have a non-PI investment, say like those Vanguard Australian Unit Trusts, again, the treatment would be the same in the sense that they are consistent within Australian Unit Trust tax treatment, which is under the fifth regime, or the foreign investment funds tax. So the way that those are taxed is that you have a couple of different ways. You either can get taxed based on the CV method, which is basically it takes any gains or losses you made during the year and taxes that, or you can get taxed on the FDR method, which is a similar method to how PIs work, in the sense that it will just deem 5% of your investment value as your investment income for the year and tax you at that rate. The difference with fifths, however, is that there is no capped tax rate. So the fifth regime means that you are taxed at your marginal tax rate. So it'll be up to 39% versus PIs, which is at 28%. So I guess within there, though, if it's an AUT where there's hedged or unhedged, it's the same treatment. AUTs are all taxed the same under the fifth regime, and the same with PIs. Whether it's a hedged or unhedged fund, if it's a PI fund, taxed the same way. So at that 28% max cap rate. Cool. Okay, next question. Does InvestNow also provide currency performance in the portfolio, so we can compare the return from currency and return from the actual asset? Yeah, that's a really interesting question, actually. So short answer is no, we don't currently break down the components of the return, but you could reach out to the underlying manager and get that information if they're willing to share it with you. I don't think they would have any issues with that. It's probably just going to take them a little bit to dig up the data, but InvestNow doesn't provide it directly, so you'll need to reach out to the underlying manager of the fund that you do invest in to probably get that data. So yeah, short answer is we don't have anything immediately available, but it's data that can be, the manager should be able to provide. Cool. Next question. Would you consider removing or reducing the spread for transferring from the Foundation Series unhedged US 500 to the hedged US 500 fund? Yeah, that's a good point. So in most instances, we wouldn't make any reduction in the spread, just because that is how we are able to offer the funds, and we need to be able to make a revenue on that. However, I am conscious that if you do have quite a significant amount and you did want to basically hedge your foreign currency exposure a bit, we could potentially consider a discount. So it really just depends on how much we're dealing with here. So if you do have a sizable amount, please feel free to send me an email, and I can see what me and the team can help you out with. I guess if it's not a massive amount and you wanted to basically, let's say, get a 50% hedge ratio, then what I would suggest is just keeping the unhedged exposure in there for now, and then any new contributions go fully into the hedge exposure, to the point that until you get basically a 50-50 kind of split, if that's what you're after, or whatever the hedge ratio you're trying to target at the end. Cool. Next question. Does the Foundation US 500 have less tax leakage than the Foundation VT? Why is this? Yep. So not fully related to hedging, but happy to answer this anyway. So yes, the Foundation Series US 500 fund doesn't have any tax leakage at all, and that's the same within the Foundation Series Hedge US 500 as well. So because they invest into the same underlying security, which is that Vanguard S&P 500 ETF, there's no tax leakage there. The reason why there's no tax leakage for those two funds is because the Vanguard S&P 500 ETF is denominated and domiciled in the US. So if you're domiciled in the US and all your underlying investments, which the S&P 500 is also domiciled in the US, then there's no tax leakage there, because essentially what tax leakage is the inability for the fund manager to get access to those like resident withholding tax credits. When you're domiciled in the same country, there's no issues with that because everything's basically done and dusted. So for the US, no problem. For the Foundation VT, or the Total World Fund, there is a little bit of tax leakage, and that's reflective of the fact that the entire fund is domiciled in the US, but not all assets are in the US. So because it's a total world fund or invests into non-US shares as well, around 40% is invested in non-US assets. So that means that within that 40%, there would be a little bit of tax leakage, because essentially they're not in the same jurisdiction as the underlying tax authority worldwide, so you can be able to get those resident withholding tax credits, and that means there's a little bit of a tax leakage or drag on your returns. So the amount that we kind of played around with is that if you have roughly 40% in non-US assets, and then you multiply that by roughly 2%, 2% of dividends, and multiply that by roughly 15% of the non-resident withholding tax credit, you're probably looking at, how's my math these days? So 15 times 2, 30, and then times 40, around 12 basis points of leakage as well. So the way I got there is 2% dividends times the 15% tax credit rate times the 40% in non-US shares gets you around 12% per year. So not massive, but it is an additional drag that the US 500 funds don't have. So good question. Next one. Over the very long term, do currency fluctuations more or less average out? If so, on that basis, could that be a reason to favor unhedged if you're investing over the very long term? Yeah, that's a really great point. So a lot of people, they do make that argument that currency fluctuations are a bit of a random walk. And what that means is essentially they'll just even out over time. So it doesn't matter whether they're up or down. Eventually, if you're kind of going long term, it's basically more or less has this like what we call it like a parity rate, where it would eventually go back to even out. So some people do subscribe to that notion, and then in that case, it makes a lot of sense to just go unhedged, because you're basically saying that any currency fluctuations or gains that I get will just even out over time. So there's no point in me paying that additional premium of going for a hedge version. So just go unhedged. So that makes a lot of sense. I guess where the potential academics would argue is that currencies aren't necessarily a random walk, and over the long term they could be heading towards one specific direction. So for example, the NZD USD at one point in time did used to be nearly 1-for-1, so now it's kind of hovered around that 50-60 cent region. So there is kind of empirical evidence that they can drastically change from what their fair value could be. The other kind of argument towards that is that even if it does kind of go back to that fair value rate over time, there's no guarantee that it will revert back within your specific investment horizon. So, what I mean by that is, for example, if you're investing for 10 years, which, is still considered a relatively long time horizon, there is still a chance that the currency, that you would have bought the currency when it was, let's say, severely undervalued, and just kept staying undervalued, during that whole period. So in which case, it may have made sense to hedge or to not to hedge. So these arguments kind of for and against, and it just kind of goes back to the point that there is no definitive answer, unfortunately. So there's good arguments on both sides, and that's kind of how we feel as well. That's why we're, at least within the foundation series, diversified funds, which is the funds that invest in multiple assets. Our approach is to go 50% hedge on the global equities. So, and again, that's just reflective of the fact that we do see good arguments on both sides. We kind of want to have the least regrets type approach, and also it aligns quite well with what a lot of fund managers are doing in the industry as well, as I kind of alluded to earlier. So, yeah, long answer, but I guess short version of it is, yes, it could make a lot of sense to just go unhedged if you are a believer that currencies will kind of even out over time. Cool. All right. Next question. Are there any other new hedge or unhedged funds on their way? So not in the immediate term. There's always kind of new funds that managers are cooking up all the time within the foundation series. There's no immediate plans to release any new hedged or unhedged funds in terms of like a pair, but we do within the foundation series, we are looking at potentially launching new ETFs as well. So the ones that kind of are on my radar as well as the NASDAQ ETF and the ASX 200, because that's been some ETFs that we do think have quite a lot of popularity amongst retail investors. And if we do see that popularity in the unhedged version, which is likely the one that we'll release first, then we can look to do a hedged version of that too. The other fund that we are in the process of releasing is a foundation series high growth fund. So again, that's the diversified fund that kind of goes mix assets across different asset classes. So within that, there is a very big proportion that's invested into international equities, around 70%. And again, the approach for that would be to hedge 50%, just to keep it consistent across both the foundation series balance, growth, and the high growth funds. So that should be on the way in hopefully the coming weeks. Otherwise, from other managers, I know there's always kind of new funds on the way. So, and we're always keen to see what investors would be interested in. So yeah, the lineup is always evolving. So watch the space. Cool. Next question. Does the foundation's US 500 hedge give dividends back in NZD while unhedged gives back in USD? Yeah. So it's a great point. So within the foundation series funds, they don't pay any dividends to the investors. So just first and foremost, so we don't necessarily pay them out to the end investor, but we still receive them. And the way that you essentially get the value of those dividends is that we reinvest it for you. So because the fund invests into an underlying US ETF, all dividends are always paid in US dollar terms. So then when the dividends are paid in US dollar terms, we immediately invest back into the fund. And then if it's the hedge version of the US 500 fund, would then hedge those additional US dividends. So essentially, although you aren't paid any cash dividends, you do get the same value of the dividends reflected in the value of your holdings by way of an increase in the value in the unit price of the fund. So you're not shortchanged anything at all. We don't keep the dividends for ourselves. We always reinvest it back for the end investor. It's just because we are reinvesting it automatically, it just goes along with the same hedging process that we always go through with in relation to any new investments. Any new application or cash that comes into the fund, we'll just immediately hedge it right away. So short answer, yep, you can basically rest assured that if you invest into the hedge version of the US 500, the dividends would be hedged back to the NZD. It's just you're not paid those dividends in cash. Cool. Let's see, do we have any other questions? I think that might be it then. So unless there's any other questions, we may just wrap it up here. So again, if there's any questions, please just feel free to email me. So the email is on the screen now. If you found this webinar helpful and you wanted to learn a little bit more about currency hedging, we do have a written article on this as well, which you can check out through the URL outlined above. And if you're interested in the new hedged US 500 and total world funds, please check out, if you just Google Vanguard Powered Foundation Series funds or find the link within the InvestNow website. These new funds are getting quite a lot of traction. And I think, for a lot of investors who probably had initially thought that they were invested in just purely the S&P 500, for example, would be quite surprised to hear that it wasn't the case. So, but now there is an option. If you did want just that pure market exposure, go ahead. If you wanted, you're happy to get some currency exposure, go unhedged. If you want something in the middle, mix and match is up to you. So that's what InvestNow is all about. We're always trying to empower investors to invest their way. So, thanks you everyone once again for attending this webinar. Hope this has been helpful. And if you have any other questions, again, just feel free to fire them through an email. We look forward to doing more of these going forward. It seems like there's quite a good appetite for more just general investor education type content. So, if there is any feedback in terms of what you'd like to see us discuss or cover next, again, feel free to send it through to us and we'll be sure to put it on the long list. Thanks, everyone. Hope you have a good rest of your day. Cheers.